In this video, I will discuss the top 3 undervalued stocks to buy for 2022 that are down 20 to 40% this year alone. These are all long-term stocks to buy and hold forever, in my opinion, yet I believe they will also rally up in the next few months, so these are perfect for day traders and swing traders as well. I have researched all of the S&P 500 companies, and these are my personal favorites that I would recommend right now that I believe will rally 20 to 40% to the upside in the next coming months. For each stock, we will do an overview of the company, key financial metrics, and my personal forecast and thoughts on the company. And stay tuned until the end as we check out my top 2 highest dividend stock picks that have a double-digit yield. We need all parents in yachts by 2025. The first stock on this list is BlackRock. Maybe you've heard of it, ticker symbol BLK. BlackRock is a widely known global investment manager which helps investors in financial planning and is a leading provider of financial technology. They offer a full spectrum of capabilities from individual securities, including ETFs, multi-assets, active managers, and private markets to fully customized portfolios. Last year, BLK reported 7% organic revenue growth compared to 3% for its competitors. Very nice. The company continues to grow rapidly using all of its tools it knows. From 2018 to 2021, AUM, or assets under management, grew 50% to $9 trillion. Call me, anyone from BlackRock. Assets under management is defined as the total market value of the investments that a person or entity manages on behalf of its clients. AUM is an indicator of mutual fund performance as well as its size. An increasing AUM may indicate positive fund performance or new customers who have brought in additional funds to be invested, or both. So let's think about the retail investing craze and how much BlackRock has profited off of that. BlackRock also continues to grow customers, with 35 million US retirement savers invest in their products through defined contribution plans. Currently, BLK is trading at $777.12 with a 52-week low of $660.15 and a 52-week high of $973.16. Yes, this is quite a big range. Market cap is $118.097 billion with a PE ratio of 20.31, very average, and EPS of 38.22. They have a good profit margin at 30.46% and return on equity is 16.21%. Now, let's look at the 1-year chart. BLK went down as far as 30% from all-time highs. This is absolutely crazy for this behemoth of a company, and we've recently seen a bit of a rally, which is good. It's currently 20% from its all-time highs and has broken the downtrend line with fierce buying pressure. While the stock has made higher highs, which is bullish, I would like to see a healthy pullback to the previous resistance at $756 to act as a new support in order for us to rally higher. This means we will close the gap and can look forward to a nice price target around $820. That's the bullseye that I am looking for. From 2017 to 2021, revenue grew from $13.60 billion to $19.37 billion. Net income grew from $4.95 billion to $5.9 billion. Total cash is $9.07 billion with an average current ratio of 1.67, which is good. We want 1.5 to 3 for the current ratio. This beast of a company provides a consistent, solid dividend too that has been growing since 2013. The dividend yield is currently 2.6%, going from 1.68 in 2013 to 4.88 currently. According to TipRanks, 10 analysts rate this as a strong buy with an average price target of $958.40 for a 23.75% upside. So even the analysts are in agreement with this one. It's important to note that earnings will take place on April 13th. So if you would like to wait until after earnings to make a decision, I won't be mad at that. Earnings estimates for EPS is $9.09 and revenue is $4.88 billion. The last 4 quarters, they beat EPS slightly, and I believe since institutions are underestimating many stocks currently, they may have another upward surprise. Goldman Sachs also today increased its price target for BLK to $850 from $800, maintaining its buy rating. This could indicate some good news ahead. While I would personally wait until after earnings to day trade this stock, the past 10 years have shown impeccable growth, so this is a great long-term hold. In my opinion, of course, I am not a financial advisor. This is for entertainment only. I hope you are fully entertained. The 5-year chart shows the stock has gone up 107.20%, and the 10-year chart has shown a growth of 347.12%. Looking at the 10-year chart, we can see a steady and consistent growing stock and the fundamentals to back it up. I believe this recent dip is a good buying opportunity. There are 3 reasons why I'm so bullish on this stock. First, they are innovating new products every year to create new revenue streams based on demand. In the past 3 years, they launched more than 170 ETFs that generated over 20% organic revenue growth in year 2021. Second, one of their main strategies is ETF growth, which they believe will reach $15 trillion by 2025. Last year, they delivered as much revenue growth as their top 3 closest competitors combined. So if you believe ETFs will grow substantially in the coming years, this is a top stock to add to your portfolio. Of course, ETFs have very low expense ratios if you can find them. Investors tend to prefer them over mutual funds or index funds. Third, BlackRock is expanding its sustainable ETFs and index funds rapidly. The high growth sustainability investing sector will grow fast in the coming years. From 2018 to 2021, its sustainable initiative has 12x, showing high demand for its products. We love a sustainable company. Overall, BLK has a solid track record, and I believe it's a good long-term hold with its rapid expansion. While the Fed recently decided not to rug pull us on interest rates, I think now is a good time to buy BLK. The second undervalued stock to buy is Meta, ticker symbol FB. Perhaps you've heard of it, but this was formerly called Facebook and has recently pivoted into dominating the metaverse. They build technology that helps people connect, find communities, and grow businesses. They use mobile devices, personal computers, virtual reality headsets, wearables, and in-home devices to allow people to connect to friends and family. Meta is moving beyond 2D screens toward immersive experiences like augmented and virtual reality to help build the metaverse, which they believe is the next evolution in social technology. Their business is separated into 2 segments, Family of Apps and Reality Labs. They own Facebook, Instagram, Messenger, and WhatsApp. In Reality Labs, AR, VR, MetaQuest, and Facebook Portal allow you to connect virtually with upgraded cutting-edge technology. Most of their revenue is based on ads they make on each social media app. Advertising revenue has increased steadily, with the majority in US and Canada. Since Q4 2019, revenue increased from $20.7 billion to $32.6 billion in Q4 2021. Since this is mainly a social media company, DAUs, MAUs, and ARPUs are very important metrics to look at. From end of year 2019 to end of year 2021, DAU, or daily active users, have increased from 1.65 billion to 1.93 billion. MAUs, or monthly active users, have increased from 2.5 billion to 2.9 billion. And ARPUs, annual revenue per user, have slightly increased worldwide this past year from $10.14 to $11.57. This is globally. Free cash flow has also increased from $4.8 billion end of year 2019 to $12.5 billion end of year 2021. Now let's look at this stock price, because this is one of the reasons why I'm extremely bullish on this company. Meta is currently trading at $227.85 with a 52-week low of $185.82 and a 52-week high of $384.33. It has a market cap of $620.19 billion with a low PE ratio of 16.55. Looking at the 1-year stock chart, we can see a severe decline in the stock price. Shares in Meta fell by 25%, which was the largest percent in history after their last earnings results revealed their first ever decline in daily users. Daily users dropped from 1.93 billion in the third quarter of 2021 to 1.929 billion. It was led by a decline in users in Africa and Latin America, and US users' growth fell as well. The CEO, Mark Zuckerberg, perhaps you've heard of him too, claimed TikTok was a key contributor. Zuckerberg was optimistic about IG Reels on the call, saying they would win back young users with short-form video. Meta is currently down 40% from its highs in September 2021. Looking at the 5-year chart, the stock has gone up 60%. We are still seeing higher lows if we zoom out, and the last 2 times it dipped to this upward trend line, it created a great buying opportunity. Looking at the 10-year chart, we can see a steady and consistent company that has soared 496%. From a trading perspective, we can see a resistance at the 50 MA. However, we recently reached a higher high, which is very bullish. There has been more buying pressure recently, and I would like to see it bounce off of previous resistance to claim a new support at 214. If we bounce off of that area, we could see a price target hit of 244. We have a huge gap to fill up once it breaks through the 50 MA. I believe we are getting close to rallying with large cap tech stocks, so I think this could rip in the coming months. They have a nice profit margin of 33.38%. Their current ratio is 3.15, which is very good. According to TipRanks, 46 analysts rate this as a moderate buy with an average price target of $325.10. This indicates a 42.68% upside. It's important to note that Deutsche Bank initiated this as a buy on March 11th. Meta is a durable and consistent company with great growth rates despite the recent stock price action. I'm bullish on this stock for 3 reasons. First, in an interview with Lex Friedman, which I will link down below in the description box, we found the truth that Mark Zuckerberg is in fact not an alien. And Mark, we're on a first name basis, mentioned for the past decade he has been experimenting with all things metaverse. In my opinion, this means he has fully researched the potential of the metaverse and has great insights to dominate the industry. Leaning more towards the metaverse as Meta's new vision, I believe will create better cutting edge technology in the form of AR, VR with Facebook and Instagram to compete with TikTok in the short term and to dominate a new high growth industry in the long term. Second, Meta has untapped potential in WhatsApp and Messenger. Credit Suisse analyst Stephen Ju highlighted this monetization potential and kept an outperform rating for Meta stock. I believe if Meta can find a way to monetize the highly popular WhatsApp and Messenger, that could be another revenue stream on its radar. Last, the metaverse, according to several analysts, could be worth $800 billion by 2024, growing at 13.1% each year, which could mean a $1.6 trillion annual value by 2030. This could mean huge revenue for Meta. While the market is forward-looking and revenue growth is expected to rally by 2023, waiting until late 2022 to buy the stock might not be a good idea. Meta is currently trading at 50% discount to other tech companies, so now may be a good time to buy. Overall, I believe Meta is a resilient company that has faced several challenges, yet its revenue and consumer base has grown. This shows the strong foundation and overall mission of the company. While I do believe there are headwinds, I feel this company is too undervalued to overlook. The last undervalued stock to buy is T. Rowe Price Group, ticker symbol TROW. Founded in 1937 in Baltimore, T. Rowe Price is a global investment management organization with $1.54 trillion in assets under management. Now, T. Rowe differs from BlackRock because T. Rowe is more of an active management company, whereas BlackRock is more of an ETF company. They both dominate their separate sectors. They provide a wide array of mutual funds, sub-advisory services, and separate account management for individual and institutional investors. The company also offers sophisticated investment planning and guidance tools. T. Rowe focuses on risk management, fundamentals, and diversification. Assets under management has consistently grown with a 10-year CAGR of 12%, with multi-asset at a 16% CAGR. Wow. Total AUM increased from $490 billion in 2011 to $1.5 trillion in 2021. From 2020 to 2021, revenue grew 11% and EPS increased 19%. Dividends raised 18% and they repurchased 10.9 million shares, meaning as investors, you get to own a larger piece of the pie. Since 2020, they have 745 investment professionals worldwide in the US, London, Shanghai, Singapore, Singapore, and Sydney. T. Rowe Price is also focused on ESG initiatives like BlackRock. Again, let's give some snaps for sustainability while launching its first responsible products in Europe in 2020. They also hired Gabriela Infante as Director of Corporate ESG. Their portfolios consist of AI with machine learning, advanced modeling, and tool building to generate alpha-generating insights, meaning better returns for investors. T. Rowe is currently trading at $153.10. I do have to say this is in my portfolio. I bought it at $148. And I have been accumulating it since 2018. It has a 52-week low of $133.07 and a 52-week high of $224.56. It has a market cap of $34.88 billion with a PE ratio of a low 11.67. It has an EPS of $13.12 with a profit margin of 40.18% and a current ratio of a modest 1.57. Revenue has grown from $4.85 billion in 2017 to $7.67 billion in 2021. Net income has 2x'd from $1.50 billion in 2017 to $3.08 billion in 2021. Now let's look at the charts, because this is again where I'm super bullish, if you've noticed a common theme from that. Looking at the 1-year chart, we can see a 30% drop since November, all-time highs in 2021. The stock is currently 10% below its 1-year stock price. The price action was mainly due to higher fund outflows than institutions were expecting. Last year, there were $23 billion in outflows during the fourth quarter. Despite this large outflow, the AUM grew to $170 billion, so I believe this is a resilient company that can get more inflows. Revenue increased 24% and net income increased 30%. Due to this recent stock action, T. Rowe is at one of the cheapest valuations in its history. While it contains solid AUM growth throughout the years, T. Rowe management believes the outflow will curb soon due to high inflation and unclear economic conditions. They believe this will drive investor demand to their portfolio strategies. But when in doubt, zoom out to the 5-year chart. We can see a 124% increase, and this looks like a good buying opportunity. If we look at the 10-year chart, we can see a price increase of 150%, so lots of room to grow. From a trading standpoint, T. Rowe has created a nice solid base and created a higher high after a nice double bottom. It broke through the 50 MA and now has a nice resistance level at 154.50. I would like to see a bounce at the 50 MA for a higher low, or at $145 to see a new support. A healthy pullback would accelerate this rally through the 100 MA. If we see a breakthrough with nice buying pressure at $156, we could see a nice rally up to the 100 MA. The weekly shows a bullish sign that we bounced off of the 200 MA. The other 2 times we have done this, we have seen all-time highs. We can also see previous resistance has become support. And there is now some nice buying pressure after a long sell-off. I believe this indicates a nice rally coming up. According to TipRanks, 8 analysts say this is a hold with an average price target of $162.94 with a 5% upside. While this may not seem like a lot, and Wall Street is definitely sleeping on the stock, TipRanks has not been updated since the stock has increased from $130 per share. Also note, VP Andrew McCormick made an informative buy, which I find very interesting, about 2 months ago. This is usually a good indication that an insider is bullish. He bought $92,000 worth of shares on February 9th of this year. Note, this is his first informative buy and he has already made profit. T. Rowe also provides a very stable and consistent dividend of 3.1%, which is much higher than S&P 500 benchmarks, about 3 times as much. It is considered a dividend aristocrat and has increased dividends for 35 years in a row. T. Rowe Price in a row. Get it? T. Rowe Price. T. Rowe Price has been paying a nice dividend quarterly since 1988, which has been steadily growing from 0.21 cents in 1988 to $1.20 in 2022. While Wall Street might not yet be bullish on this stock, I believe it is undervalued and has great room to grow. There are 3 reasons why I'm bullish on this stock. First, TROW shows great signs of strength of expansion with its recent acquisition of Oak Hill Advisors, a leading alternative credit manager with $53 billion in capital under management. This means TROW is well positioned to increase its credit, private, and real asset strategies to scale. Second, TROW has a solid balance sheet with zero debt, and $7.3 billion in total cash. TROW also repurchased 2.9 million shares, allowing shareholders to receive more cash flow. Last, TROW price is expanding globally with offices in 17 countries around the globe. This expansion is with zero debt and while giving investors dividends. While we're worrying about higher interest rates, this recession-proof stock has a hoard of cash to not worry about economic issues and expand at an expected EPS growth rate of 12% in 2022. Overall, TROW price is a fundamentally solid and expanding company whose stock price is undervalued. I mean, what else can we say about it? The PE ratio is lower than its competitors, despite being the leader in its space. While Wall Street is sleeping on this sleeping giant, the valuation remains below what investors have seen in decades. I believe the stock is primed to rally once economic factors improve with Ukraine, interest rates, inflation, and thoughts of recession. This could be a great long-term hold due to its full history of beating the S&P 500. I think the fundamentals are strong and Wall Street is being too harsh on the outflows. So those are the top 3 undervalued stocks to buy for 2022. If you stayed this long, then you definitely deserve 2 extra stocks that I have on my watch list. Please give this video a like and comment what stocks you are buying this month. Now for the double-digit dividend yield stocks. NOP and NOY. These are dividend behemoths that I am currently bullish on due to macroeconomic conditions. If you would like me to do a full analysis of ticker symbol KNOP or NOY, just let me know in the comments below. If you would like to see my trades in real time and see my accuracy, follow me at skingame.com. Link in the description box. And sign up for my free newsletter for all things finance, link in the description box below. As always, this is Supergirl Investor here to save the world and make you wealthy. Have a beautiful day. Go out and be future millionaires.
Wow.